Selling call options is known as writing a contract. The writer receives the premium fee. In other words, a buyer pays the premium to the writer or seller on option. The maximum profit is the premium received when selling the option. An investor who sells the call option is bearish and believes the underlying stock's price will fall or remain relatively close to the option's strike price during the life of the option. If the prevailing market share price is at or below the strike price by expiry, the option expires worthlessly for the call buyer. The option seller pockets the premium as their profit. The option is not exercised because the buyer would not buy the stock at the strike price higher than or equal to the prevailing market price. However, if the market share price is more than the strike price at expiry, the seller of the option must sell the shares to an option buyer at that lower strike price. In other words, the seller must either sell shares from their portfolio holdings or buy the stock at the prevailing market price to sell to the call option buyer. The contract writer incurs a loss. How large of a loss depends on the cost basis of the shares they must use to cover the option order, plus any brokerage order expenses, but less any premium they received. As you can see, the risk to the call writers is far greater than the risk exposure of call buyers. The call buyer only loses the premium. The writer faces infinite risk because the stock price could continue to rise, increasing losses significantly.